Future trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome to Pasture to Pen, a new series from the Ever.Ag Insights team. Each week, we will bring you news and updates on the markets with the intention of helping cattle producers manage their risk. I am your host, Todd Rowen, coming to you live from my home office in the Texas Panhandle, joined as always by my co-host and teammate, Trey Freeman, and then Dan Johnson from the great state of Montana, who is also on the beef team. So we will be making a cattle trio today. Before we get into this week's episode, I will timestamp the episode. Today is Tuesday, May 9th, 2023 at 3:08 in the afternoon. Gentlemen, how has Mother Nature been treating you these past couple weeks?
Doing great. We actually got a rain here in the Oklahoma Panhandle. We got 3/4 of an inch about 10 days ago. That's about the first rain we've had this year. So things look better than they did, but need a lot more to go.
Are you beating Death Valley as of?
I think so. I think it's still a tight race, but I think we are.
Good deal.
By a nose.
Dan, how are things up in Montana?
Yeah, same out here. It looks really good. We just got a little bit of sleet and snow and rain this morning, a little bit of mix of everything. Starting to see pastures green up after a few years of drought. We can definitely relate to what Texas, Kansas, all those areas have seen. So getting better now.
Sounds like you're getting about 3 seasons in one day. So there you go. Trey, what do you have for us with a futures market update?
Yeah, coming into the week, live cattle futures had posted 5 consecutive lower days. But a nice rebound yesterday and continued strength into the close today with session highs being made in the last couple minutes of trade. Driving last week's lower move in live cattle was the loss of 17,000 in open interest. This drop in open interest was less fundamental, more of a function of money flow. Turning to feeders, feeders have found support and seem giddy to move higher on continued pressure in the grain markets. Corn certainly feels heavy, and feeders are feeling it. Now, I want to turn back to what's driving the liquidation of open interest in live cattle. It's not all that uncommon to see open interest take a hit like this as a result of the money flow from funds and commercials. Additionally, open interest in live cattle historically tends to find a low into August. But with the Fed hiking rates another quarter last week, how much does each rate hike affect the decision of managed money to hold such risky positions? We've seen pullbacks met with buying support time and time again over the last 8 months. But rising rates and the crisis of confidence in the banking sector have led to a lot of uncertainty that certainly makes the case for managed money to potentially be dissuaded from entering on the long side when these pullbacks occur. Now, I don't know if the media is overhyping the banking matter. This seems to be more of a duration or asset liability matter rather than credit problems like we saw in 2008. But I do know that futures tend to overdo it to one side and then overdo it to the other. So as these banking issues appear to pop up every few weeks, don't expect the whipsaws to leave anytime soon.
Fair enough. Thank you so much for that, Trey. Before we get back to hear from Montana Dan, we will take a look at the cash side of the market. Cash cattle are also down off the highs that we saw in April, albeit not as sharply as the futures. The pullback in futures last week did shake some cattle loose on the cash side. Live cattle are enjoying a nice positive basis over futures as we move into the summer grilling season. Last week, live cattle traded in the north, 176 to 180, with most of the trade being at the low end of that range. Live cattle traded in the south at a tighter range, 172 to 174. Again, most of that trade occurring in the low end. As far as this week, show lists on the live cattle side do remain light, which is a bit of a surprise given how much of a positive basis we have cash over futures. Feeder futures are currently trading slightly over cash. We have the CME Feeder Cattle Index 7-day average that's currently sitting at 200.01 after briefly dipping below 200 last week. Moving to the cutout and the meat side, cutout values come down a little bit, but still remain strong. Choice looks really strong above 300 at 308.56. As we talked about in our previous episode with Jim Sullivan, 50s lean trim is the star of the meat locker, if you will. It is currently up 80% year over year, sitting at $199.98. Stable prices in the meat and on the hoof continue to signal good demand. And as long as we have good demand, we're going to see these good prices. Had we seen any sharp drop in the cutout values last week, we could easily conclude that these high cutout prices, high 50s prices, high cattle prices are affecting the consumer. But thus far, that is not the case. We're seeing a little bit of evidence that consumers are choosing one or the other, that they're either dining out in celebration and choosing steak, or pinching the pennies and choosing burgers. So it seems to be on one end of the spectrum or the other. We sure are excited that producers are seeing these high prices and obviously enjoying these high prices. With the run up in grains last week, it never hurts to contemplate what we like to call a multifaceted approach. We talk a lot on this show about hedging cattle in, hedging cattle out, but we also cannot overlook the impact that grains have on some of our operations. Now, to transition back to Mr. Johnson, Dan has a unique perspective on land leasing. Most of us have probably heard of leasing land, whether that be for grazing or for crop purposes. But Dan, being in Montana, has the advent of being exposed to leasing on federal lands. So, Dan, why don't you take us through that process and that aspect of the land side for Montana cattle producers?
Yeah, you bet. Looking back at federal land lease, we're going to start at the 10,000 foot level and talk about what is it. So I bet everyone's heard the term public lands. So they're federal lands that are owned by the people or by the government, which means all of us own them, all of us U.S. citizens. So what the leases are is there's two main types. So you've got Bureau of Land Management leases, and then you've got Forest Service leases. And both of them are very important. What Michael Todd brought me on to talk about was more of the BLM side, because that's where we're seeing a lot of push for conservation. So the Biden administration came out saying that they want to remove some of the mining leases, some of the cattle grazing leases, and some of the forestry leases, and be able to move those into conservation leases. So I think they're really pushing for it for climate change. And the interesting part is they've already done this once in this administration. So there was the 30 by 30 rule that had a lot of discussion behind it. We haven't seen a lot of changes follow that. So this is kind of just another tactic at moving towards this. So one of the big things for me, just being in the cattle industry, being a big supporter of it, is seeing that there's a lot of really good reasons to have cattle on federal lands. The main one being they're heavily managed. So we do a lot of rotational grazing. And then on top of it, the rancher doesn't own the land, the public land, they own the lease. So it's usually about a 20-year lease. And like I said, there's a lot of rotational grazing. There's a lot of research that's been done on carbon capture by grazing cattle with rotational leases. And keep in mind, these lands are much different than privately held lands. They're a lot rockier. Some have forest. BLM usually doesn't have a lot of timberland. But what's important is just thinking about the different reasons that cattle are very helpful to the public lands. So another big reason would be the ranchers actually pay the government for those leases. So it brings in some money, and what that's able to do is to be able to make improvements on those public lands so that then things like roads, fences, infrastructure can be improved on. And then that just helps the overall multiple use. So when we say multiple use, we're thinking hunting, hiking, fishing, any of that stuff that the general public can still get out of these public lands, even if there is cattle grazing on them still. So why it matters is it could be a really big change to the cattle industry. Like I said, this has already been pushed in the last couple years, but something to think about is when we talk about food security and just the affordability of food in the U.S., if we pushed all cattle off of public lands, it would drastically change the area where I live, definitely change the rural economy where I'm at. But it would also, it would go all the way to Nebraska and the big feeding states, just because it would really push up our cost of gain here with the feeder cattle. And then that would really change the overall value and the economics that would hit a feed yard and overall the beef market.
Absolutely. Thank you very much, Dan. Yeah, if we saw, even a tiny fraction of those federal leases go offline, that could greatly exacerbate the supply issues that we're seeing right now. Thank you so much for walking us through that. That's really great insight. That is going to do it for this episode of Pasture to Pen. Thanks so much to Trey and Dan for joining us today. Thank you, Paige. Thank you, Corey. And thank you to the entire Ever.Ag Insights team for making this show a reality. If you haven't already, hit that like button, the subscribe button, and the bell so you can be alerted of future episodes of Pasture to Pen. And above all, thank you so much to our viewers. As always, stay safe and pray for rain.